Hi, and welcome back to Stop Being Sold. My name is Michelle, and I'm here with Brian. And in today's video, we're discussing the real impact of the Fed rate hikes on you, your family, and your financial future. So we all know last week, the Federal Reserve rose interest rates by another 75 basis points after raising them by the same amount in June. And so this is what, the fourth rate hike this year, and it totals 2.25%.
Yeah, Michelle, the goal with these rate hikes is to tamper down the hottest inflation we've seen in nearly 40 years. Okay. We're all feeling the inflation, but consumers are also going to feel the impact of these Fed rate hikes if they're not already.
Yeah, for sure. And before we dive, I want to talk about the title of this video is The Real Impact, right?
Right.
But I think it's important the viewers understand the difference between, the Fed rates and real rates, because we as consumers experience real rates. So and they can vastly differ. Can you speak to that real quick about the difference?
Yeah. Okay. So the Fed interest rates are the ones that are published daily by the Fed. Okay.
Mm-hmm.
And they're used to adjust rates on things like mortgages, car loans, savings rates, and the like. So real interest rates, though, are adjusted to remove the effects of inflation and give the real rate of a bond or a loan and reflect the real cost of funds to a borrower and the real yield to a lender or to an investor. So
got it. Okay. I really appreciate that. Thank you. So before we dive in and talk about that real impact, if you like the content of this video, make sure you hit that like button, help us grow the channel. And also don't forget to subscribe so you never miss another video from us.
Definitely.
All right, Brian, let's dive in and talk about the impact on mortgages.
Okay. The rates have nearly doubled on mortgages this year, which has and will lead to a slowdown in this market. We're already starting to see that slowdown starting to hit immediately. Okay. Many think the Fed rate hikes control the interest rate paid on mortgages automatically, but they don't. Okay. Mortgage rates tend to follow more closely to the 10-year Treasury note than the Fed rate hikes. If treasuries are being bought for fear of recession, the mortgage rates will fall back down. Like this week, right now, I'm sitting here watching it. We went from over 3% in the 10-year Treasury down to 2.58 in the last 72 hours.
Okay, got it. So they're more tied to the 10-year Treasury note.
Yes.
So when the more treasuries being purchased, it does lower that rate for mortgages.
Exactly.
Okay.
Exactly.
So just for clarification here, if the Fed stays hawkish, I can't talk today, hawkish, and continues to raise rates, people shouldn't assume that this is going to jack up their mortgage rate.
Exactly.
I mean, it'll affect it because everything's tied, right?
Right.
But it's not like because they go up a percentage, right, at one point or 75 basis points that it's going to automatically send the mortgage even higher.
Yeah, because we kind of seen a peak in mortgage rates last month after the Fed rate hike the previous month in June. But now we're starting to trend back down a little bit because we over exaggerated how far it was going to go. And now it looks like the Fed is kind of like we're staying on our course. The Fed ain't deviating from what they said.
What they said they were going to do.
Surprised the market, actually.
Okay.
So,
all right. Okay.
So while we're on the topic of mortgages, let's discuss home sales. This is another area we're seeing a shift in. With the rapid rise in rates this year, we've seen home sales start to cool off. Okay, so that shows the Feds what they're doing is starting to work. Okay. For a while, we've seen multiple buyers competing for the same home and even overbidding. Yeah. Oh my gosh, that's all we hear about, right? Yeah. Now with the rise in the rates, that trend's starting to slow down and the inventory of homes should start to increase. So,
okay. All right. So let's move on to credit cards. I know I don't have the data in front of me, but I was reading an article yesterday about, more and more Americans now are taking on credit card debt like this year.
Yeah.
Not
Massive.
Good when they're rising, when interest rates are rising.
I think I just seen a ticker come across with is the highest debt we've seen in the United States in history, $13 trillion of consumer debt. So And usually, Michelle, when credit card rates will rise by the same percentage as the Fed rate increases, these move up the fastest and kind of instantly. So
Yeah.
within an hour of the Fed meeting, you got each of these banks coming up saying, hey, our variable rates on our credit cards are adjusting for next month's billing cycle. Same as like a variable rate, like a home equity line of credit that has a
Right.
variable rate, or variable rate mortgages. So these increases will mean higher APRs and longer debt payoff periods for cardholders. So,
Well, yeah. And if you also if you carry that balance month to month, it's going to jack up the amount of interest that you're going to pay overall. So not
yeah,
just longer debt payoff period and higher AP, what is it? APR, APY,
APR. So,
what?
this is a big one for consumers. If you have credit card debt, see what you can do now to bring down that balance to pay it off as quickly as possible.
For sure. And so you mentioned home equity lines, but also like personal loans, anything with adjustable rates are going to see an impact.
Yes, personal loans and home equity lines of credit, they're based on the prime rate, will go up instantly.
Okay.
So,
all right. Well, so let's talk a little bit about the good news in all of this, the silver lining, so to speak. Savings rates go up as a result of interest rates rising.
That's the best part of what's happening right now, because in all honesty, Michelle, our retirees are finally now starting to get paid for
Right.
saving. So, and that's a great thing, actually. So you're seeing CDs, bonds, high yield savings accounts, everything's starting to increase. We've been patiently waiting since 08, 09 for this to happen. MIGAs are some of the highest rates that I've seen in 2 decades.
Long
and
time.
same thing with fixed annuities. So savers, you're finally being rewarded.
Finally, because 0.00009% savings rate.
Michelle, on that subject, I have a client, long-term client, up in the years, and she used to tell me all the time, she'd show me, look what I'm getting paid on my savings. Oh my gosh. I told the bank that's not enough money to blow my nose with. Keep it. I love her.
I mean, it's funny, but it's also not funny, right?
It's not, but she's just a great person. So.
All right. So, I mean, any other impact? I mean, there's probably a lot more than we discussed, but is there anything else you want to add to our conversation today?
No, just watch this, be patient. Don't make drastic moves. This is
Well, it
all
sounds like
going.
making debt payoff a priority is huge, or at least make sure that each month you have enough to pay the increase in debt.
Yeah, the increase in the debt, definitely, because this is the real impact that we are feeling of these Fed rate hikes. It's across the board with just like every line of the financial space. So
for sure. All right. If you like the content today, please hit that like button, help us grow the channel. Do not forget to subscribe, and also hit that notification bell so you don't miss another video from us. Thank you, Brian, so much. And thanks to everybody who stayed to the end. Have a good one.
Thanks, everyone. Have a great day.